The voluntary carbon market could grow 100 times in size by 2050, says McKinsey. Jamie Keach is a well-known junior investor and runs Resource Insider. He is chair of newly formed Vita Carbon, and he's a new dad. Jamie, welcome back to Kitco.
Thank you very much for having me today.
Let's start with the headline. How's mom and the family?
We're good. Yeah, it's our first child, so it's we knew it was going to be hard. Everyone told us it was, and it was still a bit of a shock, I would say, after the fact, especially in the process of listing a company and running a business and all the things we're doing. But no, it's been great, and everyone's doing well and very fulfilling. Thank you for asking.
We will get to Vita in a moment, Jamie, but let's first talk about these markets. We're recording this on Thursday, May 12th in the afternoon. The miners are selling off sharply. The GDX is down 25% in the last month. I'm assuming this is a washout. When you look at these markets, assuming that you can get in, what do you buy? How do you assess this?
That is not an easy question to answer. I would like to come here and say I have a magic ball and can tell everyone exactly where they need to put their money. We've seen the market starting to sell off over the last week. It's more dramatic today than we have seen. What I am doing right now is waiting. What we don't know is this going to last 6 weeks? Is it going to last 6 months? Is it going to last 6 years? No one knows the answer to that right now. And I don't think this is going to be a similar situation as we saw at the start of COVID, where, the market washed out. It was rough waters for, I don't know what it was, 6 to 8 weeks maybe. And then it came back with a vengeance. I suspect that is not what we see here. I suspect we are getting a proper washout, which in my opinion is long overdue. Seeing the tech stocks down 30%, 50%, 70%, I think that is something that has been in the works for many, many years now, and it's long overdue. But the problem is that has implications for the rest of the market as well. That has implications for energy. It has implications for mining. It has implications for everything. And we're feeling the effects of that right now. For mining investors, for gold investors, the silver lining that I see is that whilst gold is down a little bit, it's nothing compared to Bitcoin. Bitcoin's been cut in half from its highs. I think this narrative that Bitcoin is just digital gold, it's the replacement for gold, I think that's over. I think real investors and retail investors are going to really see the benefit of owning gold that's down a couple percent versus 50%. So all that said, I haven't actually answered your question yet. What we're doing at Resource Insider is watching very, very carefully and trying to figure out where to best deploy our capital. There's a couple things I will say. I think when money comes back into the system, I think it's going to come into gold with a vengeance. And I think the way we are going to be playing gold, and what I'm thinking about it, there are two things I want to be focused on. I want to be focused on discovery, and I want to be focused on royalties and streaming. The reason for that is I know we are entering an extremely inflationary environment. And I know the cost of operating mines is going to go up and up and up and up and up. And we're going to see it being extremely expensive to run trucks, to replace tires, to get equipment, to get supplies, et cetera, et cetera. So I want to own royalty companies because they're not going to be really overly affected by rising operating costs. And I want to own exploration companies because still, the biggest value creation we ever see in the mining sector is, of course, discovery. And the right exploration companies, they have the most torque in a strong environment. So very long-winded answer, Michael. That's what I got for you right now.
I assume that we're also going to have to be paying attention to how much money that these junior investors have in the kitty, Jamie.
Yes. You don't want to be a junior exploration company that needs to finance today. It's funny you say that. I spent the morning with one of my analysts going through our portfolio and looking for exactly that. Which of our positions are cashed up, which ones we think are going to need to finance and call it the next 3 to 4 months. And, we're going to be making some tough decisions on where to allocate or perhaps reallocate capital based on sort of cash requirements or coming cash requirements of companies. either by good luck or strong foresight, the companies that have significant amounts of cash in the bank can afford to maintain or perhaps slow down their programs and keep going are the ones that are going to come out of this with a lot of torque behind them. The ones that have to refinance at major discounts today they're in a tough position, and it's it's not entirely their fault. They didn't necessarily know this was going to happen, but they're probably going to suffer some dilutive financings if they're lucky.
It was interesting talking about the streaming and royalty companies because they really drive this point home just in terms of them being shielded against inflation. And of course, we saw what happened with Argonaut, talking about the pain that they're suffering with the costs of running their project. Anything that interests you, though, on the streaming and royalty side? We're really seeing the case where scale really matters just in terms of having access to cheap capital.
So in terms of a position that I want to add, or in terms of what I see in the space in general?
What you see in the space.
The royalty space, it's pretty tough right now, right? So there are about 22 publicly traded precious metal royalty companies. Of those 22 royalty companies, 86% of the market cap of all royalty companies belongs to three companies, belongs to Franco-Nevada, Wheaton Precious, and Royal Gold. And when I look at those companies versus some of their peers that are newer on the block, the Maverix Metals, the Metalas, even the Sandstorms, who are a fraction of their market cap, what I don't see are companies that are doing anything notably different. They're all, great management teams making good decisions. But the real big boys, the advantage they had is that they were first. They got into the market first before people really understood the value of a royalty. Today, the margins on royalties really been squeezed out. Companies are looking for like 1% to 5% IRRs, and they're kind of banking on exploration upside to get there. They're not getting the big juicy IRRs that a Franco-Nevada got when they started the company back in 1983. So, what do I think about this? My view on royalties is that they're the perfect thing to own for generalist investors that want exposure to the space, or even mining investors that want to take some risk off the table and say, well, I still really need exposure to gold, I need exposure to silver, but I don't want to deal with the volatility now. Royalty companies tend to outperform their operating peers. They tend to outperform gold price. So what I would do personally, if I were someone at home listening to this, maybe I have some mining positions, maybe I don't have any, I would buy a basket of them. I would buy the three big ones because they've got a track record of making such good decisions. And then I buy some smaller ones as well. I'm a shareholder of Sandstorm Gold. I've been a shareholder of Metalla. So, these are companies that are on the smaller side. They're feisty. They're looking at acquiring new things. They're growing. You'll get some of that sort of M&A exposure. But again, it's about owning the space, I think, than any one name.
Let's turn to Vita Copper. Can you talk about the opportunity that you see in the voluntary carbon market?
Yeah. So Vita Carbon is I'm going to sound like a broken record here. It's a royalty and streaming company focused on the carbon credit sector, the voluntary markets. And we started this company about a year ago. I was one of the founders and early investors in it. It's being led as the CEO by a friend of mine and a colleague named Velko Bruchuk. We started this because we saw two things. The first, and I've already touched on this, is the value of royalties and streams. Franco-Nevada has, I think as of today, it's something like a $30 billion market cap. This is a $30 billion market cap with 90% plus profit margins, and they have less than 50 employees working there. This is one of the best business models that exists in the world. When I compare that to a Glencore, which has a $50 billion ish market cap, they've got over 100,000 employees and contractors working at them. So just think of the value of a business of a similar size that only has 50 people working there. Franco-Nevada delivered for investors a 38% return year after year on average for 20 years before they got bought by Newmont the first time. So it's an incredibly lucrative and incredibly powerful business model. What I've always thought about is, and I touched on this earlier, the problem is how do you apply the royalty model to a new sector? And this is exactly what Pierre Lassonde and Seymour Schulich did when they founded Franco-Nevada. Royalties were very popular in the energy space and the oil space. They simply picked up an established model and deployed it into a sector that hadn't really seen that before. Okay, that's our thesis. Why these things are so powerful. When I look at the carbon space, you said it's predicted to grow 100 times. Like, let's do just a tiny bit of mental math. So last year, 2021, the entire voluntary carbon market, there was about 100 million credits sold globally, 100 million at $10 a credit on average. So that's about $1 billion market. Now, if you look at 100 million credits sold globally, just a few months ago, Shell, energy company, committed to buying over 120 million credits by 2030. So you've got one energy company that's committing to buying more than the entire market. So that's just Shell. That's not Chevron. That's not Exxon. That's not Amazon. That's not Microsoft. That's not the 21% of Fortune 2000 companies that have committed to meeting net zero targets. So you've got supply and demand dynamics that I have not seen in any other industry, in any other space in my career. And the other thing is you have an industry that is starved for cash. Carbon credit projects, carbon credit operators tend to be smaller private companies. They're not like the gold space, which, there's any number of publicly traded, listed gold mining companies. There are very, very few, I should say, ways to get exposure to carbon markets in terms of you can't just buy an operator. Even purchasing and trading carbon credits is complicated, and it's beyond the scope of most, retail investors. It's beyond the scope of most institutional investors as well, and beyond the mandates of most funds. So when I look at, an asset class that is predicted by every analyst and commentator out there to be growing massively in scale and in price, and I look at the fact that there's almost no way to get exposure to it for investors, applying the royalty and streaming model in a publicly listed company to this space, I think represents a huge, huge opportunity.
There are entrants that are coming into this space. Jamie, how are you going to be positioning Vita?
So our thesis on Vita is very, very simple. What we've done, and this is going to sound basic, but it's very important. We have a very, very experienced team at our disposal. Our team and the consultants we work with have been at this for 25 plus years. We're working with the best people in the space. And then we're building a portfolio of high quality, diversified assets. That means assets in different jurisdictions at different stages in their development, and different project types. And there's a variety of different projects that can generate carbon credits. It's probably beyond the scope of what we can talk about today. But what we're trying to build here at Vita is a company that really has a strong, diversified portfolio of high quality carbon credits that are verified by the independent verifiers that have the strongest reputation in the space, so that when large generalist investors that are looking to, that have, hundreds of billions of dollars or more to invest, say, I want to invest in the voluntary carbon markets, we need to devote, 0.5% or 1% of our portfolio to this space. We want Vita to be the obvious choice as somewhere to invest, to get exposure, because they know that their money will be managed responsibly, deployed responsibly into high quality projects by competent people.
Jamie, thanks for speaking with Kitco.
Thank you very much for having me.
He's Jamie Keach. He runs Resource Insider and he's chair of Vita Carbon. My name is Michael McRae and you're watching Kitco Mining.